Good afternoon, everyone. Welcome to day 6 of the Strategic Virtual Financial Reporting Workshop. And we will continue from where we stopped with respect to deferred tax. Yesterday, we considered in practical terms how to determine the tax base of assets and liabilities in order to determine temporary differences, being the difference between the carrying amount and tax base of assets and liabilities. We went further to ascertain how is deferred tax determined with respect to assets and with respect to liabilities. We said deferred tax liability is determined by applying the tax rate to the taxable temporary difference, while deferred tax asset is determined by applying the tax rate to the deductible temporary difference plus applying the tax rate to any unutilized tax losses carried forward plus applying the relevant tax rate to any unutilized tax credits carried forward. Furthermore, we discussed what tax rate is applicable, whether it's enacted or substantive enacted. We gave illustrations and examples. We also went further to more or less look at, in practical terms, how we are able to answer the 5 key questions in order to appreciate and understand deferred tax. The first question we have been able to successfully answer is what constitutes temporary differences. The second question is, when are temporary differences considered taxable and when are they considered deductible? We've successfully looked at that. We also went further to understanding what tax rate is applicable. We also went further to understand what the tax base is at every point in time. Okay, and I think the other question, the 5th question, if I could check on our notes. Is how to determine deferred tax liability and deferred tax assets. Okay, and we did that yesterday with this illustration. And recall, we said deferred tax liability is obtained by applying the tax rate to taxable temporary difference, while deferred tax asset is obtained by applying the tax rate to deductible temporary difference, applying tax rate to unutilized tax losses carried forward, applying the tax rate to unutilized tax credit carried forward. Okay, now that also relates to the slide I shared earlier as at the time you guys came into the class, which is what is showing on the screen now. Okay, this chart summarizes everything we have discussed so far with respect to deferred tax and including current tax. Now, we gave ourselves a tax. And I'm going to share the screen to our task. And we'll try and solve it together now and compare it with what we individually have tried to do. Okay, I'll copy this and I'll go to my Excel sheet. Remember, we have a workbook that has been created before now, which is what I'm sharing on the screen now. Now, the first sheet was to help us to ascertain current tax. Now, we'll create the second sheet, which will assist us in ascertaining deferred tax from a practical illustration. And I can put this here so that it can assist us and we can be able to solve the problem at a glance. I want somebody to read the question for us now, and we'll attempt solving the question now. Marian Odun, I think I will grant access to you guys to, you can unmute yourself. Can you read the question? Let me enlarge it.
Okay.
Okay.
Okay. Faramola PLC starts a business on 1st January 2011 with an initial capital of 1 million naira invested in the acquisition of plants for its operations. The activities of the company in its early stage are minimal, of which accounting profits for relevant years 2011 to 2014 are fairly stable at the sum of 400,000 naira per year. The accounting profit was after all operational costs, including depreciation. The accounting profit was after all operational costs, including depreciation, have been charged. The company's depreciation policy requires a strict Inland Revenue Service requires the cost of the plant to qualify for capital allowances, that is tax depreciation, of 50%, 30%, 20% on cost for year 1, year 2, and year 3, respectively. The corporate tax rate is 40% and has remained unchanged. You are required to determine the following: A. Current taxes for relevant period. B. Deferred taxes for relevant period. C. Income tax expense for relevant period. D. Effective tax rate for relevant period.
Okay, thank you very much. We'll try and use Excel to solve it. There are 4 years involved, okay? We want to compute our current tax for this relevant period. All figure in thousands. The beauty of Excel doing it is that you can expand, you can delete, it's flexible, and which is what you use in practice. Okay. Okay. Now let's start our solution. The first question is to compute our current taxes. Okay, we start with our accounting profit. And what's our accounting profit for 2011? The question assumes that we just started business and our profit accrues evenly, which means we've not picked up per se, and our profit has remained stable at similar amount of 400,000 naira. Okay, since all figures are in thousands. Okay, Now, tax adjustments. The tax adjustment I have here is to add back
Depreciation.
depreciation. What's my depreciation? We are not given. Okay, I can carry out some workings here. Working notes. And the working note is, how do I determine the following? How do I determine my carrying amount? And how do I determine my tax base of plant, which is an item of PPE? For which year? For the relevant years, 2011 to 2014. Okay. My carrying amount is obtained for financial reporting purposes, FR purposes. Okay. And tax purposes. Okay. Now, what do I need? I'll put my years here. Year one, 2011, which is year one. Okay. I start with my costs. Remember, the asset was purchased for how much?
1 million.
1 million. That means both for tax purposes and accounting purposes, value is 1 million. Okay? Which means tax purpose is that same 1 million. I want to determine my carrying amount here. And I want to determine my position here. I want to determine my tax base here and my capital allowance. Okay. Okay. Now, first year, I charge depreciation. Remember, depreciation is assumed to be on a straight line since you are not otherwise given any other method. And we are not given residual value, which means depreciation is the cost minus residual value, all divided by the useful life. Can you remember?
Yes.
Okay. Okay, doing that is there's no cost, there's no residual value. Therefore, we divide by 4 years, which is a useful life. Okay, if that is the case, what's our depreciation amount? 1 million divided by what? 4 years. That gives us 250.
250.
Now, this 250 is what I deduct from my carrying amount in order to, from my cost, in order to get my carrying what? Amount.
Pound.
Similarly, I calculate capital allowance. What's my capital allowance? The information given here says allowance is charged on cost. Year 1 is 50%, year 2 is 30%, and year 3 is 20% on cost, which means here in that jurisdiction, capital allowance in year 1 is 50% of the cost. What is the cost? 1 million. Therefore, I come here, capital allowance is 50% of the cost, 1 million. At the end of the day, what is the what is the tax base or the written down value? It's 500. Now, this is the carrying amount. Or let me don't call it that. I'll just say this is the balance as at 31st December 2011. Now, in 2011, this balance of 750 represents the carrying amount. In 2011, this balance here represents the tax base. This is the written down value. This is the net book value. I can put it by the side. This is net book value. This is tax written down value. Okay. Now, what is the depreciation charge for this year? It's 250. And what's the capital allowance charge for this year? It's 500. Take note of it. Okay. Now, in 2012, which is year 2, again, we come down. Depreciation. The same methodology. 1 million divided by 4 years. And capital allowance. Year 2 says capital allowance is now 30% on cost. Therefore, here I pick the same 250 because straight line is the same. While capital allowance is saying 30% of the 1 million. That's 300. At the end of the day, what is my balance as at 2012 December is 500 and 300. Okay, we do the same thing for 2013, which is the third year. Depreciation is still straight line, but capital allowance is 20%. And 20% of 1 million is 200. What can you find out here is that the balance for financial reporting purposes, which is the kind amount, is 250 at the end of year 3, but the tax base, which is the written down value, is nil. Why? Because from this country tax law, capital allowance is granted for 3 years. That's why they said 50, 30, 20, which can vary from jurisdiction to jurisdiction. For example, in Nigeria, you find out that capital allowance is based on, first, there's initial allowance, followed by annual allowance. Okay. I'm just trying to put the naira sign, which is not relevant for what we're doing, just to reflect the real life situation. Okay, now for the last year, 2014, year 4, what do you do? Now, capital allowance is 0 because it has been fully enjoyed. Therefore, when it is 0, no capital allowance to enjoy again. And at the end of the day, what do you find here is that both the net book value, which is the kind amount, and the written down value, which is the tax base, equals what? Is 0. Now, the difference here that you find out here to this point is a timing difference. It's what? A timing what? Difference. Let me enlarge it. Is a timing what? Difference. Take note of it. Now, it's a timing difference because you find out that ab initio, these two agree. There's a green line there. And at the end, they agree, which means they are the same. But in between, they did not agree. The differences at this point where it is painted red is what creates a temporary difference. Is what creates what? A temporary what? Difference. Now, we are coming to that. But what we needed is depreciation, which means we add depreciation back of how much? Year one, 250, have you?
Yeah.
If you do that, since there's no other adjustment, what we have here is 650, which is our adjusted or accessible profit. Now, this profit, we don't have any loss to be relieved. Therefore, we deduct capital what? Allowance. What's our capital allowance brought forward, if any? In this question, we have no capital allowance brought forward, 0. Now, what is our additions to capital allowance for the year? Our addition for the year is the amount of capital allowance for the year, which is 500. That gives 500. How much was absorbed? Absorbed for the year. Now, we have sufficient profit of 650 that can absorb it, Abi? And let us assume that there's no restriction to 2/3. Let us say this is an agricultural company. Therefore, there's no restriction to 2/3. The only restriction is if you don't have sufficient adjustable profit, for simplicity. Therefore, in this case, we say you can't take more than what you have here or what you have here, which means that is the maximum you can take, which means in this case, we can take the entire 500 and enjoy it in the current year. And in that case, what happens? There's no balance to be carried forward. No balance to be carried what? Forward. Now we are deducting this from our profits, such that from our accessible profit, the difference between accessible profit and the capital allowance absorbed for the year will give us our taxable profits. Now, these are taxable profits. Now, what is our tax rate?
40%.
In the question, we are given how much?
40%.
Tax rate is 40 what? %. Okay, if that is the case, what is my estimated taxes? It's simply, if this is Roman figure 1, And this is Roman figure what? 2. Therefore, estimated tax will be Roman figure 1 multiplied by Roman figure 2. It means is a product of 40% multiplied by the taxable profit, which means at the end of the day, this is our taxable profit. Our current what? Tax. These are our current tax, 60. Now this is for year 1. Year 2, we start all over again. We are told that the profit is 400. It means it's the same. Our depreciation in year 2, what is it? It's still 250. Okay. And our capital allowance is this. Therefore, I'll just be picking, I'll link it to it. Now my depreciation here is 250, which means I can just sum so that it can flow. Now, what is my capital allowance brought forward? My brought forward will be the carry forward for last year. But since it is 0, it's also going to have a 0. What is my addition for the year? Is 300 for 2012. Now, based on the equation we have put there, that is the lower of the actual capital allowance due for absorption and the assessable profit that you will pick, because you can't turn assessable profit to a taxable loss. There's nothing like taxable loss. What you have is simply taxable profit or no taxable profit at all, because losses are to be carried forward. Therefore, I can take the entire 300, which means once I take 300 out of 650, I'm exposed to tax at 350. And at 40%, I'm paying 140. I do the same thing for 2013. My profit in 2013 also is said to be fairly stable at 400. My depreciation in 2013 is 250. My balance carry forward in 2012 is what I bring forward in 2013. Now, what is my addition for the year in 2013 is 200.
100.
And what I can absorb is the entire 200 because I have sufficient profits. Therefore, I have taxable profit of 450. Tax rate is 40%. And I recognize current tax of 80. Final year. It's still 400. My depreciation is 250. My opening balance in 2014 is my closing balance of capital allowance in 2013. My additions for the year, unfortunately, is 0 because I've enjoyed all of the capital allowance. Now, nothing to absorb, which means the entire 650 is exposed. If you remember what I said yesterday, when you enjoy more capital allowance earlier than how you depreciate, you will have enjoyed enough that at a later date, it exposes you to more taxes. But if you enjoy less earlier, at a later period, it exposes you to lower taxes. And that is the principle behind temporary difference, whether it's taxable or it's deductible.
Sir, please explain this absorb for the year again, sir. Absorb capital allowance.
What is that how much of your capital allowance can you deduct from your profits in the year? If your profit is more than capital allowance, therefore you can deduct all of that capital allowance. But if your profit is lower than the capital allowance, therefore you can't deduct more than the profit.
Yes.
So that the balance you cannot deduct is what you carry forward. As time goes on, we'll see whether we have such situation or not. At the end of the day, this is our current tax. This is our what? Current taxes for 2011 till 2012, till 2014. Any question on that?
Hello, sir.
Yes, go on, sir.
Hello, sir.
Hello?
Hello, sir.
Yes?
Go on.
Yeah, please, what's the principle behind the 23 to 3rd of the absorbed capital allowance?
Okay. Now, first, I'm not using that assumption here of 26 to 3rd.
Okay.
But the reason behind 26 to 3rd is that government wants to ensure that you don't use capital allowance available for you to more or less put you in a position where there's no tax to pay at all.
Okay.
You can say that. So that government prefer that, okay, when you have more capital allowance, spread it for a longer period so that at least you have something to pay every year. Because government need money. You can say now, that is rationale. So that, because if anybody is deducting capital allowance early enough so that there's no profit, a year will come, nobody will pay tax. And government must pay salary. They don't accrue for salary. They pay salary in cash, not accrue. That's why I see that whenever there's a cash flow shortfall, government will start to pursue all these agencies. Go and collect money, collect this, collect that. You can see now. It is to ensure that at no point in time, you don't have sufficient profit to which you pay as little as possible amount of tax. Okay? Still come to minimum tax, the effect on what we are doing. Now, that is what we have done so far. Now, the second question says we should compute deferred tax. Now, estimation of deferred tax. Now, I want to determine deferred tax. Therefore, I can use this table to determine deferred tax. I think I should do it here, side by side. Now look up, please. I'll have my year. Now, what brings about deferred tax is the existence of temporary difference. And what brings about temporary difference is that there's a difference between the carrying amount and what? And the tax base. And that difference is temporary what? Difference. And once you apply the tax rate, you get the amount of deferred tax. The years 2011, 2012, up to what? 2014. Does that make sense?
Yes.
Okay. Now, off we go in thousands. What is my carrying amount? What I'll do is, let me eat this first. Let me eat this. I'll come back to open it. Or don't let me eat it. Let me just freeze this panel. And I can shift it to the, can you see it? Okay. So that I can see it clearly. Now, what's my carrying amount? My carrying amount at the end of year 1 is 750. End of year 2 is 500. End of year 3 is 250. End of year 4 is 0. What is my tax base? End of year 1 is 500. End of year 2 is 300. End of year 3 is 0. And end of year 4 is what? Is 0. Now, is there a difference between the two? Is there a difference?
Yes.
There's difference, Abi.
Yes.
Yes.
Now, the difference is what? This minus this, Abi.
Yes.
And the difference occurred up to where there's no longer any difference. Now, this difference is what we call, what can you call the difference? Is it temporary, is it taxable or deductible?
It's taxable.
It's taxable or deductible?
Taxable,
It's taxable. Why is it taxable?
because the carrying amount of an asset is greater than the tax base of the asset.
Now, again, logically, why it is that you find out here that because you enjoy more capital allowance earlier than when you compare it with your depreciation, you find out that earlier years you are paying little tax, but at a later date you now be exposed to bigger tax because there's no allowance to reduce your loss, your tax profits, taxable profits. And that is why I said that by way of description, if you have better understanding, anytime there is a temporary difference that will give rise to higher taxes in the future, such difference is considered taxing. Otherwise, it will be considered what? Deductible. Now let's go back. Therefore, it means here I will emphasize that this difference is a taxable temporary what? Difference. Now, what is the tax rate? It remains 40% across, Abi. Therefore, what is my deferred tax? Is the product of the tax rate and the temporary what? And this gives me my what? My deferred tax for the what? For the year. Now, the deferred tax we arrive at here, is it a liability or an asset?
Deferred tax liability.
Why is it a liability?
Because we still have to pay it in the future.
Yeah, and that the tax rate is applied on the taxable temporary difference. Does that make sense?
Yes.
Now, but this is item for balance sheet, not for the income statement. Now, to determine deferred tax expense or deferred tax credits, it is a movement you look for. Deferred tax expense or credit. Now, you know, this is our first year of accounting based on the question. It means there's no opening balance coming from anywhere, which then means that your first deferred tax liability will arise as a result of expense increasing liability from 0 to 100. And if it's deferred tax asset, it will be credit from moving from 0 to 100. Therefore, it means 100 is our starting point. There's no movement because we don't have opening what? Balance. This is the first year the company came into existence. Now, as time moves on, it is a movement in it between the balance at the end of the year, 2012, and the balance at the end of the year, 2010, which means there's an additional expense of 20 recognized between 2011 and 2012 because the liability has moved from 100 towards 120, which means there's an expense of what? 20. But in year 3, the liability has reduced from 120 to what? 100.
100.
Which means it starts to reverse because it's a timing what? Difference. Can you remember timing difference?
Yeah. Yes.
This difference is not permanent. It's just for a while. As it originates initially at 100, it starts to reverse itself. Up to what point? We'll see it. Now, as at year 4, it has totally reversed itself to 0. Which means it shows another credit. Which means the negative is a credit in this case. Which means a reduction in liability is an income if it affects equity positively. Why an increase in liability is an expense if it affects equity negatively. Therefore, this represents our deferred tax. Alternatively, I can still do the same thing and say, what I determine up here is deferred tax liability. I can use another approach down here to determine my deferred tax expense or my deferred tax what? Credits. I'll come here. I can say this 2014 to 2011, 2012,
2013 and 2014.
We're going what? Thousands. I'll come here and say my deferred tax liability as a beginning, 1st of January each year. I'll compare it with my deferred tax liability as at the end of each year. The movement in this is what gives me my deferred tax expense and credits. Like here, remember, this is expense. This is expense, and this is what? Credit. Now, what is my opening balance for deferred tax liability? It's nil, because the business just commenced. But if it's an ongoing business, you would have an opening balance. Now, in the first year, my liability stood at what? 100. Can you see it here? As at end of 2011. Now, we ask ourselves, what is the movement? The movement between the beginning and the end create an expense of what? 100. And don't forget, my balance in 2011, as of December, is my opening balance in 2012. And my closing balance in 2012 as computed is 120. And what is the movement again? Additional increase of 20, which creates an expense. My opening balance in 2013 is my closing balance as at 2012. And in 2013, my new balance as computed was 100. And what happened here? It started to reduce. Reduction in liability that positively affects equity is an income, which creates a credit here. And my opening balance in 2014 is my closing balance in 2013. And in 2014, independently, we can put our deferred tax liability to be 0. And therefore, at this point, it has totally reversed. Which means either of the approaches, you are still going to get the same what? Answer. That is that. Now, finally, we are told to determine our income tax for the year. Expense or credits for the year. And what's our income tax for the year? It's made up of what? Current taxes and what? Deferred tax. What do we have? What are our current taxes? Remember, we've done our current taxes here, 60, 140, 180, and what? 260. What is our deferred tax? Our deferred tax expense, 100,
100.
and I link it together. These are expense These are credits. Therefore, what is our income tax reported in our statement of profit or loss and other comprehensive income? What can you guys deduce here? Is something not shocking to you that our income tax remain fixed or constant at 160 million?
Why, sir?
Does it make sense? Now, let us prove it. Look at it. Deferred tax is not tax. The difference you are observing is as a result of timing what? Differences in the recognition for tax purposes as opposed for what? Financial reporting purposes or accounting purposes. You find out that at the end of the day, the difference reverses to zero because the differences are temporary in what? In nature. Temporary means it's not something that is going to be there forever. It's just for a while. And that while is as a result of time. As time elapses, the difference in what will fade off. That is why you find out that when you sum up all of this, it gives you zero. Can you see it?
Yeah.
Which I can sum up here. This is the reason why we say it is not tax, because it will sum up to what? Zero. It will sum up to what? Zero. Secondly, you find out that the amount of tax you actually pay to FRS in 2011 up to 2014 stood at how much? 640. And the amount of tax you also recognize for accounting purpose on a straight line basis by assumption, since our profit remained on a straight line of 400 across board and the tax rate has not changed, it will also be 640. Which means deferred tax is a way of trying to smoothen the effect of tax on your performance, all things being equal. Which means deferred tax is not a tax, but rather an adjustment against current taxes, because current taxes did not rely on your actual financial performance or profitability, but rely on tax profitability, of which the rule that determines tax profitability differ in some ways from our accounting rules or principles. And that is what gives rise to deferred tax. Invariably, there is no tax in deferred tax. It's as a result of timing what? Difference. The difference you thought exists does not exist for long. It's only something that exists just for a while. And that is deferred tax. Does that make sense at all?
Yes.
Why? Because, let me do one miracle for you to prove that deferred tax is not tax, and that's the beauty of Excel. Let us assume that for tax purposes also, capital allowance is given for 4 years on a straight line what? Basis. If that is the case, it means we come here and say, if capital allowance is given on a straight line basis, instead of 50%, it's 25% for 4 years. It's 25%, for example. which means I'll come here and say instead of 50 is 25. Instead of 30 is 25. Instead of 20 is 25. And instead of 0 is what? 25. Check. Would there be any temporary difference?
No.
There won't be. Okay, this we didn't put negative there. That's why I wrongly deleted the negative. There won't be. That means your current tax will be equal to the income tax. The timing difference is just with respect to recognition. Tax law is recognizing depreciation faster than accounting.
Faster than accounting, yes.
But if they recognize depreciation in the same manner,
there will be no difference.
Transaction in the same manner, there would never be difference, which tells me that the difference arose because of timing of recognition. And those differences are temporary in nature. Am I making sense at all?
Yes, yes, sir. Yes, sir.
Yeah. That is that. What I can do is, let me copy this and paste somewhere. Do you get what I'm saying now? And put an assumption here that assume that capital allowance is charged on a straight line for forward years. If that is the case, there won't be timing difference. There won't be what? Timing difference, which means here, I'm just going to, let me paint it. I discard this. Do you get what I'm saying now? Are you getting it now? I discard it. I replace it with this. You get the logic? Okay. I just say scenario for deferred tax. That's a scenario. Okay, let me go back to my original answer. My original answer is 50. $30, $20, and what? 0. $50, $30, $20, and 0. Return to our position. Does that make sense, please?
Yes.
Now, if we are told to determine our effective tax rate, very simple. Your effective tax rate how do you determine that? Effective tax rate is equal to your income tax expense as a ratio of your profits before taxes. Now, for each of the year, our effective tax will be what? Income tax of 160 as a ratio of these profits. And that gives me 40%. Divided by 400 and 200, and year 12, 40%. In 2013, 160 divided by profit in 2013, 400, and in 2014, and that is it. That's my effective what? Tax. Now your effective tax should naturally approximate your corporate tax rate. What was our corporate tax rate? 40%. Now, but as time goes on, it will not be equal. Who can tell me why it may not be equal as time goes on? Who can tell me why it may not be equal?
Yes, sir. Hello, sir.
Yes, sir.
Okay, I think the reason why it may not be equal as time goes on will be as a result of adjustments that will be made on accounting profits, especially the accrued expense that will not be tax deductible in the nearest future, and some accrued income that will not be taxable in the nearest future. That is my assumption. Thank you.
Okay, thank you. Who else? Who else? Okay. Now, it will not necessarily be the same going forward if the following happens. If there are permanent differences that exist between accounting and tax, that's something that will never reverse, which means it's not timing difference, but it's a permanent what? Difference. Such are things that are totally disallowed for tax purposes, and they are not going to be allowed whether now or in the future. That is number one. Number two, it will be the same peradventure if there is a change in the rate of tax along the line. And we're going to see that today. Which means when there's a change in tax rates, it will affect it so that our effective tax rate may not be equal to our corporate tax rate, especially in the year of change. Also, when you have some other differences along the line, this might not necessarily allow you to agree. That is why IAS 12 requires us to carry out a reconciliation. And there are two ways to which you can carry out a reconciliation. Let us quickly jump to that. Let me share the slide.
Question, please.
Yes, sir.
So what's actually the what are we trying to achieve with the terms effective tax rate? What is it in particular?
Okay, you know, when you are doing tax planning, one of those things that you use to evaluate your effectiveness in tax optimization is that your effective tax rate is more or less the actual amount of tax that is likely impacting you, so that it is expected that effective tax planning should allow your effective tax rate be lower than the corporate tax rate, which means you are harnessing some benefits. You are effectively planning your tax. You can say now.
Okay.
Because, for example, if you don't plan your tax at all, you should just pay what is due as actual tax, so that you are not taking opportunity of the loopholes in tax law, so that similar transactions might have different tax consequences. That is why when you structure transaction, you look for the way you can structure it, even though it will get the same result based on your financial objective, but one will have more tax advantage than the other. For example, if you have idle funds, what do you do with idle fund in your company? What will you tell if you're a finance manager, what will you tell your CEO that we should do with our idle fund? What will you tell your CEO?
You should invest.
Invest it.
In what?
You have to look at a viable project.
Government bond, invest in government bond.
Why government bond? Why not? Given that the two will give you the same interest, why government bond and not fixed deposit?
Depends on the investment that gives us optimum reward.
I have told you that each of them will give you 10%.
Give us
10%.
Okay,
Why?
so fixed deposit, you can quickly call it back.
What about government bond or 20%? You can't call it back.
Government bond is sometimes long term.
And it's not tradable.
I think for government bonds, the interest is tax exempt for government bond. I think so.
I've said it up to the tax exempt, which means that you have to achieve the same objective of utilizing your idle fund. But again, if I put it in fixed deposit of 10%, once I earn it, it will suffer withholding tax. And I'll still subject it to normal company tax and later deduct withholding tax to know the amount of excess tax to be paid. But for government bond or short-term government securities like treasury bills, it's totally exempted from tax. Are you getting me now? If you have decided to go to fix it in GTB and I decide to fix our own in government bond or treasury bill, you find out that effectively I will have reduced my tax than yours, even though we are subjected to tax at the same corporate rate. Am I making sense at all?
Yes.
Yeah.
That is it.
Okay, thank you.
Okay. Okay, now I want to show you reconciliation. There are two ways you can reconcile. The first way is what you have seen on the screen. I can reconcile accounting profit with taxable profit. And how do I do that? This is my accounting profit. This is my accounting profit, year 5, year 6. when I apply the corporate tax rate, I get this. Now, what are the things that more or less will create permanent difference? You can see this: charitable donation, fines and environmental this. Can you see? Reduction in opening resulting from reduction in tax rate. You know, there was a change in tax rate between the 2 years, 35 from 40% to 35. These are the things that reconcile, so that when you reconcile it, it brings you back to your actual tax expense in your financial statements when you compare it with your tax, when you apply the rates directly. Now, the second alternative is that you can reconcile relatively, which is to reconcile your effective tax rate, which is otherwise known as your average tax rate, with your corporate tax rate. Are you making sense? Do you get what I'm saying now? And that is what we do. And in this case, we reconcile the 40 and 35% to what is our effective tax rate. You find out that here, effective tax rate is higher, while here it is what? Lower. What could have accounted for that? Do you get what I'm saying now? And that is what we are saying. Does that make sense, please?
Not really.
Which means I'll give you a tax. You might go and use this. Okay, you don't even need to reconcile here. Therefore, the tax will be irrelevant because your corporate tax rate, which is your applicable tax rate, is equal to your what? Effective
tax.
But as you move on, I'll find exercises or practical scenarios where you have to do that reconciliation yourself. Does that make sense?
Yes, sir.
Okay, thank you. Now, any question on that? Now let's look at this is deferred tax based on question 12, have you?
Yes.
Okay, we'll now use the same template to solve question. And the beauty of Excel is that I'll not repeat myself. I'll just change the parameters. Does that make sense?
Yes.
Okay.
Hello, sir.
Yes, sir.
Yeah, sorry, can you just give me an example of income that will not be taxable for tax purpose?
I'll give you an example today. Interest on government securities are exempt from tax in Nigeria.
Okay.
Beginning from 2011 to 2021 is for 10 years.
Thank you.
Yeah.
So sorry, after the 10th year, what will happen?
And if you to status quo, it will be subjected to tax going forward. Any income you earn on government bond, whether as an individual or as a corporate.
Okay, sorry, is not a standard. For as an individual, if you start getting interest after 10 years, to subjected to tax.
The window was just open for 10 years. It was signed into law by the provision of the CITA that gives the Honorable Minister then, who is also the coordinating Minister for Finance and Economy, Dr. Ngozi Okonjo-Iweala, who rose to the occasion to give that exemption. And the reason was that to facilitate government local borrowing as a substitution for foreign borrowing, so that people can have incentive to buy government bonds and government treasuries once they are issued. Does that make sense?
Yes.
It's an incentive to encourage people to lend money to government as at then. Does that make sense?
Yes.
Okay, let me copy question 13 and paste appropriately. Now, I've copied that question 13. And I'm using the same solution of question 12, only that I'll change the parameter. What has changed? What has changed is that they told us that based on question 12, not question 11. Let me try and amend this. Based on question 12, based on question 12 above, but as at the end of year 2012, the IRS, which is the FRS in this case, announced a change in tax rate to 30%. But that change will take effect not in that 2012, but will take effect from January 2013. Now, in this case, we now have two tax rates. We have how many tax rates? Two tax rates. Now, I want you to tell me which one is enacted tax rate and which one is substantively enacted tax rate. Who can tell me? Who can tell me?
Yes. 40% is enacted tax rates, while 30%, the new tax rate, is a substantively enacted tax rate.
How do you get to know that?
Because 40% is in existence before, while 30% is a new tax regime that will be effective and on 1st 2013, 1st January 2013.
Thank you very much. Now let us see how this affects our question. Now I delete all the tax rates. I delete all the tax rates here too. Because now we are confused. We are having two rates. One enacted, one substantively enacted. Which one should we use? Which means I want to expose you to how effect in change in tax rate and pronouncements impacts our computation of income taxes, both at current tax level and at deferred tax level. Now, in 2011, do you even know or have any clue about government changing tax rate at all? Do we have?
No.
Do you have a clue?
No, sir.
In 2011? No.
No, sir.
The tax rate is still 40 what? Percent. Both for current tax and for what? Deferred tax. I put it there. Since I've modeled the template. And this is what you do in real life. You don't start to do things all over again. You develop a template so that it will not be a plug and what? Play, subject to one or two adjustments based on when something is new to that template. Are you getting what I'm saying now? Which means you don't just start everything. That is how you create effectiveness and efficiency. Not that you now start again, sweat again, sweat again. Something that becomes repetitive. To make it a robotic so that it's just little things you do, not starting all over. You get what I'm saying now? And that increases your productivity. Now, in 2012, what is the rate existing in 2012?
40%.
40%.
40%.
But in that same 2012, government has announced that new tax rate is now 30%, but it will take effect from 2013. The question is, if you are now filing your assessment for current tax in 2012, which rate are you going to pick? Is it 30% or 40%?
40%.
40%.
40%.
40 what? Percent. Okay. Therefore, I put 40%. Let's look at deferred tax. Under deferred tax, in 2012, what rate are you going to put? Is it the 30% or 40%? Is it 30% or 40%?
40.
40.
40.
Why?
Because we are still considering the difference between 2012 and 2011.
Who has another view?
I think it should be 30%.
Why, sir?
Yeah, because there is a standing enactment, and the deferred tax relates to subsequent year. So the tax that is to take effect in 2013 will be good for the deferred tax that is postponed till the following year.
My brother, thank you very much. Let's look at this key point on deferred tax. Point 3. Can you read it, my brother, Shegun?
To reflect, capture.
Reflect or capture.
Okay, to reflect or capture the future tax consequences of current period transaction and events.
Deferred tax is capturing what has been omitted. Everything captured under current tax is not omitted, and they are current items. But the portion of it that is left out, uncaptured, is what deferred tax capture. And deferred tax is only capturing something that has a future consequence. It's already making provision for it against when it crystallizes. Which then means that the expectation of deferred tax that you are doing that to capture what will crystallize. Which then means that at the point it will crystallize is not today, but in the future. Rate relevant for deferred tax in that regard is the rate that will be relevant in that future. Which means it's like when you are preparing for exam. Imagine you're writing ICAN ACCA, and the standard has changed. For example, revenue standard has changed. Before it was IAS 18. Now it has changed to IFRS. But let's assume that in 2019 you are preparing for the exam, and the standard will take effect from 2020. What do you expect ICAN and ACCA to teach you and examine you on? Is it IAS 18 or IFRS 15? So that when you qualify, what you qualify into is what? Is what will be applicable. Am I making sense? Yes, of what value is IAS 18 that they will not teach you? By the time you now qualify, it's no more in use. Are you getting the logic? That is what the first tax is saying, that you will make use of the tax rate that will be applicable when the future tax consequences is expected to materialize, is expected to crystallize. In that case, as at 2012, you are already aware of the rate that will take effect from 2013. Therefore, that is the rate you will use, even though it has not taken effect. And that is the essence of understanding the word substantively enacted tax rate, which is the tax rate expected to more or less take preeminence as at the time this temporary difference will reverse. And I can show you also from our presentation slide. Let me turn. Now, can you see my screen? Now, the effect of changes in tax rates. Where the corporate rate of income tax fluctuates from one year to another, a problem arises in respect of the amount of deferred tax to be credited or debited to profit or loss in later years. This amount could be calculated using either of these two methods. But of those two methods, it's only one of them that's acceptable to IAS 12. What are the two methods? The first one we have is the deferred method. Now, what does this method say? Deferred method assumes that deferred tax account is an item of deferred tax relief, which is credited to profit or loss in the years in which the timing difference are reversed. And therefore, the tax effect of timing difference are calculated using the tax rate correct when the difference arises. Now, what does this say? This method is saying, no, let us use the current tax rate today, similar to how we did that for current tax. Next year, upon doing the reversal, we'll make use of the new rate. But the second method, which is the liability method, says what? The liability method says otherwise. It says, let us assume that the tax effect of timing difference should be regarded as an amount of tax ultimately due by or to the company. Therefore, deferred tax provisions are calculated as they occurred in the year. Only a single adjustment to the opening balance of deferred tax account is required. And that is what we wanted to adopt. Adopting it in the sense that we are going to assume that as at end of the year, we'll factor in that accelerated movement in tax rates so that the opening balance will have adjusted cumulatively the amount of impact such changes in tax rate has on the computation of deferred tax. And summarily, I said IAS 12 requires deferred tax asset and liability to be measured at the tax rate expected to apply in the period where the asset is realized or the liability is settled, based on tax rate and loss enacted or substantively enacted at the year end. In other words, IAS 12 requires liability method to be adopted. That is it. And let us see how we adopt that. Which means we make use of what? 30%. Now I'll do something here. Sorry, that will not work. Let me insert something here. Okay, now let me draw. Let me see whether drawing can. Oh. Okay, let me draw. Okay. Now, let me come here. also, I'll draw here the change, start from here. Which means going forward from 2030, the new rate is 30%. 2014 up to a future period where the rate is changed again. Okay, now why deferred tax is 30% from this point downward? Now, what can you see? These are the new estimated taxes. Where changes arise is this amount. $135 and $195. And also here, and at the end of the day, at every point in time, deferred tax is no tax, zero, regardless of changes in tax rate. Now look at this place. You find out that in 2011, the effective tax rate is 40%, which equals the actual rate then. In 2013 and 2014, it is 30%, which has returned to our new rate, 30%. But in 2012, 2012 is a year of change. And in that year, is where we need to carry out a reconciliation because it will affect it. And the reconciliation will account for the effect of the new rates on our tax computation. And that is that. Does that make sense? Any question here? Starting from our income tax, only rate difference. Our current tax has no contention about which tax rate is applicable. But where we have the challenge is on deferred tax. And as I've said earlier, if you are confused, always refer to this. Any question? Any question? Now, we also copy this and use it to solve question 14. I will call it a day for today and continue from there. I'll give you a task through your WhatsApp group, and I want everybody to partake in that before next week. Because we'll wrap it up next week, except for aspect that deals with deferred tax on business combination, which we are going to do only when we have finished group accounting and accounting for business combination. Now 14. What is question 14? Let me go and copy question 14. Now this question 14 will expose us to something new. Who can read question 14? And let us see the difference.
Paramola PLC starts a business on 1st of January 2011 with an initial capital of 1 million naira invested in the acquisition of plants for its operations. The activities of the company in its early stage are minimal, of which accounting profits for relevant years 2011 to 2014 are fairly stable at the sum of 100,000 naira per year. The accounting profit was after all operational costs, including depreciation, have been charged. The company's depreciation policy requires a straight line basis of cost allocation. The Inland Revenue Service, IRS, requires the cost of the plants to qualify for capital allowance, that is tax depreciation, of 50% in 2011, 30% and 2011, and 20% on cost for year 1, year 2, and year 3, respectively. The corporate tax rate is 40% and has remained unchanged. Required, you are to determine the following: A, current tax for the relevant periods; B, deferred taxes for relevant periods; C, income tax expense / income for relevant periods; D, effective tax rate for relevant periods.
Thank you very much. Now, what is different between this question is that it's not 100 that they made as profits. It's not 400, but what? 100. And what does that mean? It means it will reduce the amount of, what's it called? It will reduce the amount of capital allowance that they can easily absorb. And see it. Yeah, they have 350 as acceptable profit, but they can only absorb 350 out of the 500, which means they will carry forward how much? 150. This 150 is carried forward to 2012.
As opening balance.
Yes, as opening what? Balance. Can you remember?
Yes.
It's carried forward there. Now in 2012 again, it's 100 they made. 350. But what they have is 450. What can they absorb? 350. They carry forward what?
100.
100 again. In year 3, they made 100 again. The profit is 350. Luckily here, all their capital allowance to be absorbed is 300, which means 350 and 300. They can easily absorb all the 300.
Yeah.
Therefore, nothing is carried what? Forward.
Oh.
Does that make sense?
Yes.
And yeah, there's no capital allowance again. All what you have here that will carry forward to next year is that. Now, at the end of the day, you find out that there was no taxes paid in year 1 and year 2.
We are not done with year 4.
We are done with year 4.
The profits.
Accounting profit should be changed to
100.
To what? 100. Thank you.
Yeah.
Now, you find out that year 1, year 2, there's no profit and there's no tax. But bulk of those taxes were shifted to what? Year 3 and what? Year 4. That is that. Now, deferred tax is computed. We have deferred tax liability here. Okay. But remember that we have unutilized tax credits of 150 and 100 that is carried what? Forward. Therefore, when you have unutilized tax credits or unutilized tax losses carried forward, what will it give rise to? Will it give rise to deferred tax? Yes or no?
Yes.
And what type of
deferred tax assets?
Deferred tax assets.
Assets. Now let us hear our slide again. Remember what we said here. Deferred tax assets. Where it concerns us is this point. This point. Which means it will give rise to asset. Therefore, what will I do? I'll quickly come here on my Excel and compute deferred tax what? Assets. Which means I'll come here I can shift this downward. Can you see the beauty of Excel? It makes our life simple. Now I'll say I want to compute deferred tax deferred tax assets and this deferred tax asset is on what? Is on unutilized tax what? Credits. Carried what? Forward. Therefore, now what is my tax base for this? My tax base in year one is what? My tax base in year one is what? Where is it? 150, Abi?
150. Tax base.
My tax base in year two is what? 100.
100.
My tax base in year three is what?
0.
0. In case you didn't see it well. And my tax base in year four is what? Is 0. Therefore, what is the implication? Because in this case, the kind amount of it is greater than is less than the tax what? Base. It becomes what? Deductible. That is why it's going to give rise to what?
An asset.
An asset. And in that case, this gave me negative. I remember our negative is a credit, Abi?
Yeah.
And our positive is what? An expense.
Mm-hmm.
Does that make sense?
Yeah.
Okay. Therefore, what has happened here is that I now have to sum up the deferred tax expense together. Now, what is my sum of deferred tax expense? Therefore, I want to mix it together. What do we have? Deferred tax expense combined. Because you have to net everything up. I have deferred tax on plants, which is an asset. And I have deferred tax on unutilized tax credits. Carried what? Forward. Okay. Now, this is this. And this is this. Where's the other one I did? Okay.
Rest of that place.
I have expense here. I have expense here. And I have
40.
No.
That place is.
Yes, I'm
Credit.
looking at that 40.
Which 40?
Year two. Year two. Is it not to be minus 20? It should be a credit.
It can't be credit. Your asset, this is asset now. Your asset reduces in value.
Okay.
Forget the sign. Forget the sign.
Okay, I've seen it. Yeah,
You don't use sign there. Sign,
yeah.
you understand?
No, I've seen it. I've gotten it.
Okay. Ignore the sign. This is an asset.
Yeah,
okay.
Yeah. I've gotten it.
This is what? An asset. That's why we said it is less than the tax base. Therefore, it gives rise to deductible, which create deferred tax for what? Assets. Think that in your mind. Okay. Therefore, this is our deferred tax. $40 net. This is net of credit. This is net of what? Expense. Which means the impact at the end of the day is still zero because you are netting off expense with this. Do you get what I'm saying now? Your deferred tax Okay, now this credit here will net off the expense. That's why 100 minus 60 will give you net expense of 40. 20 expense will give you 40. Negative, which is credit, and 40 expense will give you net expense 20. And credit 100 and 0 will give you credits. At the end of the day, what is our current tax? Is 0 in year 1, 0 in year 2, 20 in year 13, 140 in year 14. By the time we apply the net position here now, you'll see what our position is going forward. Does it make sense now? Can you see? Our income tax is now 40, 40, 40, 40, which is 40% of what? 100. Remember, this is 100, and our tax rate is what? 40%. When you apply it on 100, it gives you what? 40, which you are seeing here. Does that make sense now? Which means I've shown you how to determine deferred tax assets on utilized tax credits. The same way you'll have done it if you have any tax losses that is carried forward. Does that make sense?
Yes, sir.
Yeah. Any question? Any question? Any question? Any question? Any question? I'll share this template with you, but there are still more templates we'll come across when we get to serious business. Is that okay?
Yes, sir.
Any question before we call it a day? Okay. Now let's move further. Let's talk about this. To what extent do you recognize deferred tax? There are three schools of thought. This first school of thought says that deferred tax should not be recognized at all. Why? Because one, it creates complexities. Two, it's difficult for people to really understand its essence. Even today, we have thousands upon thousands of greater proportion of qualified accountants, professional accountants today struggle with deferred tax in understanding, in computation, or in anything. Therefore, that school of thought believes that deferred tax should not be recognized. It should be ignored. Which means just pick the income tax you computed in line with your tax law, take it as your income tax, which means income tax should equal to current tax, not income tax equal to current tax plus deferred tax. The second school of thought says there is a reason and there's a logic behind recognition of deferred tax. But there are some areas to which recognize deferred tax that may not be necessary, or because of the complexities, let us compute deferred tax on some portion that is clear. And the argument is that it's easier to compute deferred tax on qualifying capital expenditure. That is, compute deferred tax only on items such as property, plant, and equipment, investments, and probably intangible assets. So that we can be able to at least be comfortable with it. The third school of thought considered that regardless of it, based on conceptual framework, completeness is key to faithful representation of information contained in the financial statement. Which then means that it will be termed a gross omission not to recognize deferred tax in full. Which means we need to recognize deferred tax as far as is practicable on all assets and liabilities. Therefore, of these three schools of thought, the position of the board, which is IASB, is that full provision should be taken. And next week, God's willing, we expose ourselves to on what do we compute deferred tax is on all assets and what liabilities, and we're going to identify them. And I'm going to show you a template I've developed in doing that for a typical company. Secondly, another argument says that time value of money is critical in every consideration in accounting and finance. Therefore, all what we have done so far, we have never used or adopted nor annexed the principle of time value of money with reference to what? Discounting. Which means, can't we apply discounting as a principle in the computation of deferred tax? But the standard says no. Who can tell me why the standard says no? Who can tell me why the standard says no?
Okay, let me just say this. Hello?
Yes, sir.
Yes, that's my own understanding that since deferred tax has to do with the future, and if we had this thing, time value of money to it, we relate it more to the current position, but deferred tax has to do with future transaction. That is the way I understand it. So,
when you estimate the future, it's the same we are dealing with deferred tax, and it's because of future that we are factoring time value of money, which means that argument may not sail through. Who else can argue further? Okay, there are two reasons why discounting is not applicable in the computation of deferred tax. The first reason is that in arriving at the carrying amount of some assets and liabilities, you find out that some of them, by principle, either by fair value or by present value measurements, in order to determine the value in use or their fulfillment value, time value of money is a consideration in arriving at such carrying amount. An attempt to discount the temporary difference can be tantamount to double discounting. That's one. But you can also argue that, okay, what about those assets that are carried at historical cost, which has not applied time value of money? Why can't you do that? The second argument now comes in to say, because of the complexities, because of the fact that it might be difficult to trace the movements and the reconciliation of deferred tax as time goes on, it might become onerous and it can be a burden on us such that the benefit of reporting will be eroded by the cost required in complying to that. And in that regard, the board resolved to ignoring the principle of discounting solely for the purpose of computing what? Deferred tax. And this summarizes it all. IAS 12 states that deferred tax asset and liability should not be discounted because the complexities and difficulties involved will affect the reliability, which erodes the objective of financial reporting. Discounting will require detailed scheduling of the timing of the reversal of each temporary difference, but that is often impracticable. If discounting were permitted, this will affect comparability, so it is barred completely. And lastly, however, carrying amount determine temporary difference, even when such carrying amount are discounted. Does that make sense at all to us? That is that, which means on no occasion can we apply that in our discussion. Any other question? Any other question? Okay, in the next class, we'll be looking at the following. We'll look at exceptions to the recognition of deferred tax. Are there any exceptions to we not recognizing deferred tax? We are going to see that next week. Okay, deferred tax arising from business combination, we'll see that many weeks to come after we've dealt with accounting for business combination and group accounts. Also, with respect to how do we present impact of minimum tax, excess dividend tax, withholding tax in our financial statements? We also discussed that extensively, probably next week. Okay. Any other question? Any other question? In the absence of no question, thank you very much for today, and God bless you all. I'll share the document with us, okay, so that you can make use of it. And during the week, just check the WhatsApp group for more information and tasks. Thank you very much, and God bless you. Good night.